You've probably heard some chatter about new rules being implemented by the Biden administration that will increase fees on new mortgages. It has certainly become a hot-button political issue. So on this week's Fastest 4 Minutes in Finance, we're going to try to offer some clarity. Well, the rules, which did go into effect May 1st, will change the fee structure charged by Fannie Mae and Freddie Mac. Those are the government-sponsored organizations that are responsible for about 50% of mortgages in the United States. So it affects a lot of home buyers. The fees will go up on borrowers with good credit scores and go down for borrowers with riskier scores. Here's an example. A buyer with a score of 740 and a 15% down payment would have paid in the past 0.25% on their mortgage. That is now going up to 1%. A borrower with a score of 640 with a 15% down payment is going from 3.25% down to 2.5%. So the borrower with the lower credit score is still overall going to pay more on their mortgage, but the new rules do seem to penalize someone who has built up good credit at a time when homes are becoming more difficult for first-time buyers to afford. Mark Calabria, who ran the Federal Housing Finance Agency under President Trump, told Financial Advisor magazine that buyers with weak credit and low down payments are especially vulnerable to default. And he said, quote, "It's the equivalent of putting someone out there in a rubber dinghy during a tsunami." With recession risk and interest rates rising and some banks failing, it does seem like a bad time to potentially issue riskier loans. At the same time, homeownership is becoming a pipe dream for many younger people. According to a survey from Lending Club Corp, almost 2/3 of what are called Gen Z, that's defined as 26 years old and younger, were living paycheck to paycheck in March. That's an 8% increase from a year ago. That means they have no emergency savings and would be immediately in debt if an unexpected cost arose. Higher inflation has driven up the cost of even basic necessities at a time when these younger Americans are starting out and making lower incomes. So not only are they not saving money, they're putting more money on credit cards. Credit card debt reached an all-time high earlier this year, and recent data suggests delinquency rates are on the rise, which would affect those credit scores. The fee changes instituted this week clear a path to home ownership for more people. Vanessa Perry, a professor at George Washington University School of Business, told Bloomberg News that, quote, "It's not the case that every category of person with good credit will pay more. There's not that sort of direct relationship here, and it does not affect any particular category of borrower across the board." She says this is an effort instead to adjust risk-based pricing, or in other words, re-estimate the cost associated with bearing those risks from the government perspective. However, it is shifting that cost in part to those with good credit. There's no question that sometimes low credit scores are not exclusively a result of poor money management. But at the same time, good credit scores are a good sign that mortgages will be paid. It's possible the fee changes will not be a significant enough change to further damage the economy. But the better question here is, why would we even want to take that chance? Thanks for watching.